Trading the smart money concepts and ICT methods can be incredibly rewarding. But for many traders, they often become a source of frustration and failure. Two of the most dangerous traps that traders fall into are related to liquidity and inducement. These concepts, while powerful, can easily mislead even experienced traders if not fully understood and properly applied. So if these topics interest you, give this video a thumbs up to show your support and subscribe if you are new. Liquidity, the double-edged sword. Liquidity is the fuel that drives the markets. In the context of SMC and ICT, liquidity refers to the availability of orders in the market that can be used to move prices. These orders are often clustered around key levels, such as highs and lows, and are a magnet for price action. The allure of targeting liquidity is undeniable. After all, if you can predict where the market will go to grab liquidity, you can position yourself to ride the wave. But here lies the first trap. Traders often fall into the trap of targeting liquidity without considering the structure bias of their strategy. Liquidity should not be hunted in isolation. If the liquidity you're targeting is not within the structure bias of your strategy, you're essentially gambling, not trading. For example, if you're in a bullish market structure and you target liquidity beneath the lows without considering that this liquidity grab might be a mere inducement for the market to continue higher, you might end up stopped out of a trade that was otherwise perfectly aligned with the broader trend. The key to avoiding this trap is to ensure that your liquidity targets align with your strategy's structural bias. If the market is in a bullish trend, the liquidity you target should ideally be on the buy side, and keep in mind that the price is likely to dip momentarily before continuing its upward trajectory. On the other hand, in a bearish market, you should look for liquidity on the sell side. By aligning liquidity targets with the structure, you increase the probability that the market will move in your favor. Inducement, a trap disguised as opportunity. Inducement is another concept that can easily lead traders astray. Inducement refers to the market's tendency to lure traders into positions that appear to be safe but are actually traps. These traps are often set just before the market makes a significant move in the opposite direction. For instance, price may create a series of higher highs, enticing traders to go long, only for the market to reverse sharply and trigger their stop losses. The mistake many traders make with inducement is misunderstanding its role in the context of an order block. An order block is a critical point in SMC and ICT trading, where institutional orders are likely to be placed. When inducement occurs in front of an order block, it can actually be a signal of confirmation rather than a trap. If you recognize that the market is inducing traders to take positions contrary to the order block, you can use this to your advantage. By waiting for the inducement to play out and the market to reach the order block, you can enter the trade with more confidence, knowing that you're aligned with the institutional flow. However, if you fail to recognize inducement or misinterpret it as a reversal signal, you may find yourself exiting trades prematurely or entering at the wrong time. The market often uses inducement to shake out weak hands before making its true move, and if you're not aware of this, you can easily be among those shaken out. The common solution between the traps of liquidity and inducement is the need to align these concepts with your overall market structure, bias, and strategy. Liquidity should be targeted when it aligns with your structural bias, and inducement should be recognized as a potential confirmation signal rather than a trap. By including these concepts within the context of your trading plan, you can avoid these common pitfalls and improve your chances of success in trading SMC and ICT. Remember, it's not enough to know these concepts. You must know when and how to apply them correctly. So watch this video next, where I show you a full strategy step by step for free.